Hi there, welcome to V-Ignite's educational video on financial ratios for small business owners. As a business owner, it's important to understand the financial health of your company and track key metrics to make informed decisions.
In this video, we'll be covering the following ratios: solvency ratios, including the debt ratio, debt-to-equity ratio, and interest coverage ratio; liquidity ratios, including the current ratio and cash ratio; profitability ratios, including the profit margin, return on equity, return on assets, gross margin, and operating margin; achievements, including sales achievements, gross profit achievement, net profit achievement, and cost savings. Let's get started.
The first set of ratios we'll discuss are solvency ratios. These ratios measure a company's ability to meet its long-term debt obligations. Debt ratio. This ratio measures the amount of debt a company has compared to its assets. For example, if a service industry company has $100,000 in assets and $50,000 in debt, its debt ratio would be 0.5, meaning that 50% of its assets are financed through debt. In the manufacturing industry, a low debt ratio may be preferable, as it suggests the company is financing its operations primarily through equity, while in the trading industry, a higher debt ratio may be acceptable if the company is able to generate enough profits to cover its debt obligations. Debt-to-equity ratio. This ratio measures the amount of debt a company has compared to its equity. For example, if a manufacturing industry company has $100,000 in equity and $50,000 in debt, its debt-to-equity ratio would be 0.5, meaning that its debt is equal to half of its equity. In the service industry, a low debt-to-equity ratio may indicate a conservative financial strategy, while in the trading industry, a higher debt-to-equity ratio may be acceptable if the company is able to generate high returns on its investments. Interest coverage ratio. This ratio measures a company's ability to pay its interest expenses. For example, if a trading industry company has an operating profit of $100,000 and interest expenses of $20,000, its interest coverage ratio would be 5, meaning it can cover its interest expenses 5 times over with its operating profits. In the service industry, a high interest coverage ratio may indicate a strong ability to meet debt obligations, while in the manufacturing industry, a lower interest coverage ratio may suggest that the company is relying heavily on debt financing.
Next, we'll discuss liquidity ratios. These ratios measure a company's ability to meet its short-term obligations. Current ratio. This ratio measures a company's ability to pay its short-term obligations with its current assets. For example, if a service industry company has $100,000 in current assets and $50,000 in current liabilities, its current ratio would be 2, meaning it has $2 in current assets for every $1 in current liabilities. In the manufacturing industry, a high current ratio may indicate a strong ability to pay short-term obligations, while in the trading industry, a lower current ratio may suggest a high reliance on short-term financing. Cash ratio. This ratio measures a company's ability to pay its short-term obligations with just its cash and cash equivalents. For example, if a trading industry company has $50,000 in cash and cash equivalents and $20,000 in current liabilities, its cash ratio would be 2.5, meaning it has $2.5 in cash and cash equivalents for every $1 in current liabilities. In the service industry, a high cash ratio may indicate a strong liquidity position, while in the manufacturing industry, a lower cash ratio may suggest a high dependence on short-term financing.
Now, let's move on to profitability ratios. These ratios measure a company's ability to generate profits and return on investment. Profit margin. This ratio measures a company's net profits as a percentage of its revenue. For example, if a service industry company has $100,000 in revenue and $10,000 in net profits, its profit margin would be 10%, meaning it made a 10% profit on its revenue. In the manufacturing industry, a high profit margin may indicate efficient operations, while in the trading industry, a lower profit margin may suggest a more competitive market. Return on equity. This ratio measures a company's net profits as a percentage of its equity. For example, if a manufacturing industry company has $100,000 in equity and $10,000 in net profits, its ROE would be 10%, meaning its equity generated a 10% return on investment. In the service industry, a high ROE may indicate a strong ability to generate profits from equity, while in the trading industry, a lower ROE may suggest a more risk-averse investment strategy. Return on assets. This ratio measures a company's net profits as a percentage of its assets. For example, if a trading industry company has $100,000 in assets and $10,000 in net profits, its ROA would be 10%, meaning its assets generated a 10% return on investment. In the service industry, a high ROA may indicate efficient use of assets, while in the manufacturing industry, a lower ROA may suggest a higher dependence on debt financing. Gross margin. This ratio measures a company's gross profit as a percentage of its revenue. For example, if a service industry company has $100,000 in revenue and $20,000 in gross profit, its gross margin would be 20%, meaning it made a 20% profit on its revenue before accounting for operating expenses. In the manufacturing industry, a high gross margin may indicate high profit products, while in the trading industry, a lower gross margin may suggest a more competitive market. Operating margin. This ratio measures a company's operating profit as a percentage of its revenue. For example, if a trading industry company has $100,000 in revenue and $15,000 in operating profit, its operating margin would be 15%, meaning it made a 15% profit on its revenue after accounting for operating expenses. In the service industry, a high operating margin may indicate efficient operations, while in the manufacturing industry, a lower operating margin may suggest a high cost structure.
Finally, let's discuss achievements. These ratios measure a company's performance compared to its goals or previous periods. Sales achievements. This ratio measures a company's sales performance compared to its goals or previous periods. For example, if a service industry company had a goal of $100,000 in sales for the year and ended up with $110,000 in sales, its sales achievement would be 110%. In the manufacturing industry, high sales achievements may indicate successful marketing and sales efforts, while in the trading industry, lower sales achievements may suggest a more competitive market. 2. Gross profit, GP, achievement. This ratio measures a company's gross profit performance compared to its goals or previous periods. For example, if a manufacturing industry company had a goal of $20,000 in gross profit for the year and ended up with $22,000 in gross profit, its GP achievement would be 110%. In the service industry, high GP achievements may indicate successful cost management, while in the trading industry, lower GP achievements may suggest a more competitive market. Net profit, NP, achievement. This ratio measures a company's net profit performance compared to its goals or previous periods. For example, if a trading industry company had a goal of $10,000 in net profit for the year and ended up with $11,000 in net profit, its NP achievement would be 110%. In the service industry, high NP achievements may indicate successful operations and profitability, while in the manufacturing industry, lower NP achievements may suggest a need for cost optimization. Cost savings. This ratio measures a company's cost savings compared to its previous periods. For example, if a service industry company saved $5,000 in operating expenses compared to the previous period, its cost savings would be $5,000. In the manufacturing industry, high cost savings may indicate efficient operations, while in the trading industry, lower cost savings may suggest a need for cost optimization. In conclusion, it's crucial for small business owners to have a good understanding of their financial health and performance. By regularly tracking and analyzing key financial ratios, you can make informed decisions and stay on track towards achieving your goals. V-Ignite's BHD is a powerful tool to help small business owners monitor their financial performance, track ratios, and make data-driven decisions for growth with a user-friendly interface and robust features. If you're looking to improve your financial management and achieve your business goals, we highly recommend trying BHD.
Thank you for watching, and we hope this video has been helpful in educating you on financial ratios.